So right now we're looking at a chart of the Japanese yen. And why are we looking at a chart of the Japanese yen? Well, because this week we have two big central bank meetings coming up. Well, actually three, but two that we're going to focus on. The first being the Fed on Wednesday, and then a few hours later that evening, we're going to be hearing from the Bank of Japan. And this is going to be an important meeting from a standpoint of, what is the Bank of Japan going to say about the potential for raising rates again in the future? We know that Japan has a bit of an inflation problem right now. And at the same standpoint, we know in the US, we clearly have a little bit of a slowing labor market, but we also are clearly on a path where the Fed will be lowering rates. Obviously have very big impacts on things like currencies and even interest rates. And interest rates and currencies are very important, especially when it comes to what's happening in the equity market here in the US. I'm going to explain to you why I think that is in a few minutes. But first, I just wanted to look at the yen and kind of go through with what I think is really important and key here. What's important and key here is that basically over the last couple of weeks, we've really seen the spread between US and Japanese interest rates really begin to compress and to narrow. When you take the Japanese yen and you overlay it with what you've been seeing in rates, what you realize is that all of a sudden, after basically years of the yen trading with this interest rate differential, we've seen a major divergence. And really, you can go back and start tracking this going back as early as, January of 2021. Anyway, before we get too much into the intricacies of the carry trade and what's been happening in the Japanese yen, please remember to subscribe to this channel, like this video, share it with your friends. Remember, I am trying to grow the channel and I need your help to do that, so please hit the subscribe button so you're sure to catch the next video as well, where this was a very integral spread and it told you a lot about where Japanese yen was going. In fact, if you were paying attention during this period of time in 2024, you saw the spread really begin to narrow, but the Japanese yen actually weakened during that period of time. And then, of course, we know we had that yen-mageddon period of time where the Japanese yen strengthened materially all around the world. But now we're seeing something similar happening. And in some ways, this is actually a little bit more profound because it's been going on for quite a bit of a long time. So, for example, this went from April until about July, so figure 4 months. This has been going on really since April, and now here we are in September, and this is actually, the spread is actually continuing to widen out. And that could tell us a lot about what's happening really beneath the surface in US equities and in markets around the world. And you're also seeing the same in Europe, where you can see that the yen has really weakened versus the euro. And you can see the same thing when you look at the Aussie dollar, Japanese yen also. So basically, we've been seeing yen weakness all over the world. And this really comes despite the fact that you've seen, a Japanese 10-year rate go to, 1.6%, some of the highest levels it's been in decades. And you've seen the 30-year go up as well, and a 5-year go up, also to levels not seen in decades. And really in Europe, you haven't really seen the same type of movement in rates. In fact, the movement in Europe in terms of rates has been similar to that of what we've been seeing in the US. So what's kind of interesting, I guess, is that despite the fact that you've seen, the spread between, German and Japanese 10-year rates coming down, you've still seen this period of time where you're really seeing the yen weakening. And again, it's not as strong of a correlation. If you go back further in time, you can see the relationship has always been there. But clearly there's something that's kind of taking place around the world. I was doing some work on this actually earlier today, and what we have here is essentially the what we were just looking at when it came to the spreads between US and Japanese rates with the yen. What was interesting about this period of time is that we've been seeing actually a 5-year and 1-year forward rates on the Japanese yen actually rising as well, suggesting that the market is actually pricing in a weaker yen in the future than where it had been earlier this year. In fact, the 5-year forward was pricing the yen around 119 and now the yen is being priced around 130, while 1 year is trading around 142 versus earlier in the year at 136. And again, this is despite the fact that you're seeing these interest rate differentials really breaking down. And you can even see in this case how the forward rate really was trading right along with the interest rate differentials as well. And it kind of gives us a sense that maybe interest rates differentials really aren't driving the yen's weakness at this point, that there may be something else driving this. And what's interesting, I guess, is when you take the Japanese yen and you just look at the cross-currency basis swap, the 5-year basis swap, and you basically, since April, the yen has been trading much more with the direction of the basis swap. And that could be telling us that what's really happening here is that there's actually a yen carry trade that's actually still being put in place, potentially in other parts of the world, but specifically here in the US. And the reason why I come to that conclusion is because when you take the forward out, you can see that basically the S&P 500 has been trading right along with this 5-year cross-currency basis swap. And essentially what this kind of implies to me is that what you've been seeing in the marketplace right now is a market that's not really focused so much on the interest rate differential, because they're potentially not using it. Traditionally, what you do when a carry trade is to, you borrow in the currency with the low interest rate and you go long, the currency with the higher interest rate. And that obviously that spread has been contracting. So it's not really as desirable today to be putting and initiating a carry trade in interest rates on, because that spread is much smaller today than what it used to be. And the idea here is that it almost appears that there's a carry trade being put on so that the use of the fund, the use of the proceeds from shorting the yen and borrowing dollars is actually being put into the stock market. And that's important because essentially what you have right now is a scenario where it's quite possible that you continue to see these spreads contract. It's quite possible then at some point the weight of the spread narrowing begins to pressure the market in such a way that you begin to actually see the yen break down and that trade return in a similar way that maybe we saw what was happening here in August of 24. In fact, when you kind of zoom in and you look at this period of time a little bit more closely, the currency started to deviate from the rate of change in the interest rate. This was in August of 24. You can clearly see that the spread was narrowing while the currency was actually weakening. And that's likely because you actually during that time saw the cross-currency basis swap moving up. The yen was actually still weakening, and at the same time, the S&P 500 was also going up. And then, of course, we had that really big shock that really started right around the middle of July. If you remember, at that point in time, the BOJ kind of hit the market with these ideas that it was going to potentially raise rates, and then it did end up raising rates, and then we got this really bad job print here in the U.S., and that caused, basically the big sell-off that we got in equities, and Japan specifically went down significantly. It basically sent in a very short period of time the yen from around 160 to around 140 within a 2-month period. But the big move happened between July 10th and August 5th, right? So you had basically a 20-day window where the yen went from 161 to 144. And of course, we know U.S. equities experienced about an 8% decline during that time, while you saw, Japan go down, 12% or something in one day. And so when you look at the market today from that standpoint, what it looks to me like is that what's actually happening in this market right now is that you have a yen that's really trading along with the basis swaps and with forward rates based off of what we're seeing in the marketplace that's deviating from the narrowing of the spread on interest rates. And it looks like the money is literally going into U.S. equity prices. And it's quite possible that if you get a scenario again where the BOJ doesn't necessarily raise rates, but really kind of goes through this process of talking about why it's going to need to raise rates in the future. Now that things have kind of settled there, down in terms of the trade war, you could really begin to see rates continue to go higher in Japan, especially if they start talking about, potentially reducing the amount of bond buying they're going to do to support the long end of the curve, which is something they've been trying to slowly, pull back on. And at the same time, if the Fed were to come out and deliver a picture that suggests, you're going to get multiple rate cuts over a short period of time, that you could potentially really see the pressure on this rate spread really begin to move down sharply. And that could really force the hands of investors that aren't really participating in this latest leg of carry trade, but from older periods of time, to potentially really start buying the yen back because of the narrowing of the spread, which could actually kind of unwind everything that we've been seeing here as well. It's just, look, I mean, it's hard to, sit here and try to predict the future in this type of precision, because it's a very complex concept and it's a very complex trade. But I think that the elements are there. And obviously, lots of things need to go right for anything to really happen in a big way. But the most important thing that needs to happen for this to start, signaling any warning signs, is you need to see basically the interest rate differentials continue to contract. You really need to see the yen begin to strengthen versus the dollar, and preferably against things like the Aussie dollar and against the euro as well. But I think if you start seeing those two things happening in a really meaningful way, I think that could be the sign that you're going to see that pullback in the equity markets we've been looking for some time now that hasn't really developed. And this is just one other thing that I think is worth paying attention to this week, because I don't think many people are really focused on the Bank of Japan again and the potential impacts it could have on global markets. Anyway, thanks for watching, and remember to subscribe to this channel, like this video, share it with your friends, and we'll see you again during the week.